Let's talk about the economy now. Our hopes for a year-end rally set to be dashed by bad data. One of my next guests warns the rise in jobless claims this week means a recession is coming. The other says not so fast. Let's bring in Greg Daco, chief economist at EY-Parthenon, and Chris Rupkey, chief economist at FWDBONDS. Our senior economics reporter, Steve Liesman, joins us as well. Chris, I'll start with you. And how serious is the recent backup in both initial and continuing jobless claims?
Well, for all these leading indicators, so-called, of turning points in the economy that people have researched for decade after decade, there's always some uncertainty out there, of course. It can't really be predicted. But the most immediate, timeliest indicators are the weekly jobless claims data. And right now, it looks like it's picking up a little in a worrisome manner. So once continuing claims is the most leading indicator, well, it's actually initial, then continuing, then the unemployment rate. It looks like, as I like to say, it's kind of get ready, get set, go. Right now, we're getting ready, getting set. It's looking like it could be a possible recession.
Right. You say, as you titled your note, Americans will be having recession this Thanksgiving, although we hope maybe it hasn't started already. There's still some time. Greg, you're not so sure that the dreaded event is coming. Why?
Well, I think it's clear that we're seeing a slowdown in economic activity, and I think Chris is absolutely right to point out the labor market. The labor market has been really the key pillar in terms of economic activity. We are seeing a softening in terms of employment growth, but that softening is not as pronounced as we would start to worry about. The key question going into 2024 is how pronounced that slowdown will be. If it's a controlled slowdown where the value of talent remains elevated and business leaders continue to preserve talent to navigate this uncertainty, then we won't see a recession. If instead morale seems to shift and we start to see more pronounced layoffs, then that's going to impact income, and that will directly affect consumer spending, which has been quite resilient up until now.
Steve, I keep thinking about our discussion with Claudia Sahm and her line towards the end of that interview where she said that the reason why she based her little recession metric off the unemployment rate is that once it starts to rise, it usually keeps going. So right now, this half-point rise doesn't feel to anyone like the end of the world, except for the fact that it usually keeps going, and that, would seem to be the most likely case now.
Yeah, Kelly, that's the question with an awful lot of data. One thing I've been watching closely are the delinquency data, a lot of which has gotten back to risen to the pre-pandemic highs, and you don't know where it stops. Look, I came on this show mostly to listen, Kelly. I was hoping that between Chris and Greg, I was going to know which way to lean. Most of this past year, I haven't been in the recession camp, and it's been the right call. But what's gotten me more nervous, actually, is the rise in interest rates and knowing that consumers are really feeling this and businesses are going to feel it. I think one thing that was not mentioned as being very critical to the outcome is the extent to which rates remain high and companies have to refinance their low pandemic era debt into those higher rates. If the Fed can ease back just in time before we hit some of those refinancing cliffs, I think we might avoid it. But if a lot of companies have to refinance and consumers as well into those higher rates, then I think we risk a potential recession.